Hi, today I'm here to talk about what are the 5 steps for making a profit in crude oil trading. Due to its unique position within the global economic and political systems, crude oil trading has significant potential for profit in almost all market conditions. Additionally, the volatility of the energy industry has increased significantly in recent years, ensuring strong trends that can deliver reliable profits for both long-term timing methods and short-term swing trades. Because they haven't learned the specifics of these markets or because they aren't aware of the hidden hazards that might eat into profits, market participants frequently fall short of maximizing NBSP, the benefits of variations in crude oil prices. Additionally, not all financial instruments with an emphasis on the energy sector are created equally. A subset of these assets is more likely to have favorable outcomes. Crude oil is subject to perceptions of supply and demand, which are influenced by both global output and economic success. While rising demand and dropping or flat output encourage traders to bid crude oil higher, an abundance of supply and declining demand drive traders to sell crude oil markets. The rise of crude oil to $145.31 per barrel in July 2008 was the result of tight convergence between positive elements. Conversely, the fall of crude oil to $37.75 per barrel in August 2015 was the result of tight convergence between negative variables. When crude oil reacts to mixed conditions, price action has a tendency to form narrow trading ranges, with sideways activity frequently lasting for years at a time. Energy futures markets are dominated by professional traders and hedgers, with market participants taking positions to counter physical risk and hedge funds making predictions about the long and short-term outlook. Compared to highly emotive markets like precious metals or high-beta growth equities, retail traders and investors have less effect in this one. The power of retail increases when crude oil prices climb substantially, luring tiny participants into these markets with attention-grabbing headlines and table-pounding talking heads. The ensuing waves of greed and terror can amplify the velocity of an underlying trend, which can lead to historically significant climaxes and collapses that print extraordinarily large volumes. While WTI is the benchmark for the U.S. light oil market, Brent crude has utilized NBSP for the worldwide light oil market, which includes Europe, Africa, and the Middle East. Both Brent and WTI are frequently used by other nations as benchmarks to value their crude oil. To generate regular returns, traders in the crude oil and energy sectors need to possess outstanding skill sets. Trading crude oil futures and its multiple derivatives require NBSP, market participants to understand the factors that affect the commodity, the makeup of the crowd, the long-term price trend, and the physical differences between different grades. For the typical investor, purchasing stock in an oil drilling business is the most straightforward investment strategy. Additionally, equity in an oil services firm can be bought by investors. Investors can have a more direct exposure to oil as a commodity by purchasing energy sector ETFs. Through the use of derivative methods, traders may profit from the fluctuating oil prices. On the markets that provide crude oil derivative products, these often involve concurrently purchasing and selling options and taking positions in futures contracts. Bye everyone, but have a good day and please subscribe to our channel and make sure hit a bell icon so that you can get latest update.